Welcome back, everyone. We have an exciting video to get into today. First of all, we have some news. Peloton just striked a deal with Amazon to sell all of their equipment and apparel. And this may not seem like a big deal because it's just one company, Peloton, which has been struggling recently. But I want to go into the news report on this because I think it highlights some really interesting and insightful things into what's going on between all of these different companies that have to sell their product and their relationship with Amazon. Now, we also have more Amazon news. Apparently, according to this Bank of America analyst, Amazon is continuing to grab more market share, and he expects their revenue growth to be above the consensus estimates. So we'll go ahead and look at this report as well. Now, we also have one bit of other news that I want to get to, and this is more of like almost a political topic at this point. Twitter just had a whistleblower, an ex-security head, an ex-employee, come out and blow the whistle a day before the trial started. I wanted to give my quick take on it, so we'll be talking about that as well. Now, as you know, at the Joseph Carlson Show, we do things for real. If you're new to the channel, I show real money invested, real capital. This is really $107,000 of my money. It's a big part of my net worth. My dividend portfolio is considerably bigger, but these make up most of my invested capital. This is really where my money is. So the reason that I like to show, good or bad, what happens with this portfolio is because I feel like having a level of transparency is really important when you listen to so many gurus online that never share their returns. That's always bothered me, to have other gurus tell you what to do with your finances. They don't share what they're doing with theirs. And they're always doing great, and their stocks are always outperforming. And when the market goes down, they're still making money because they were short the market, they were hedged. That's what the gurus do, and most of it is a facade. It's inaccurate. They're not showing you the full story. At the Joseph Carlson Show, we show you the full story. I show you exactly what's happening with every dollar invested, exactly the results every single week. So if you value that and that level of transparency, you can pay me back for free by just subscribing to the channel, following along for free. Now, like I said, I give weekly updates on this. If I look at the past week, we got hit at 4.3%. Not terrible, right there with the S&P 500, but that is almost $5,000 in the red. And basically every company except for Baba and Crocs was in the red over the past week. All of these are down. They're all down around 4 to 7%, so around the same. This is just normal trading. When the entire market, when every company trades down 5 or 6%, it's not because of anything your individual companies are doing. It's just the way the market works. So I don't find this concerning at all. I think it's normal trading. It gives you opportunity. If you're wanting to buy these companies, now you can buy them 5 or 6% cheaper. Now, another way that I look at this with an eagle eye view is using a tool that I developed called the Dip Finder. This shows you the price versus the 200-day moving average. That's what this says right there, the price versus the 200-day moving average. And this is a technical way to look at if your companies are objectively trading down with negative momentum or they're trading up with positive momentum based on their current price against their 200-day moving average. When I look at this story fund here, we have all the companies off to the left, and if they're in the red or green today, and then we have all these companies individually here. The story fund has the majority of companies, all of them aside from Apple, trading downwards. They all have negative momentum so far. Now, they're getting a little bit closer to the positive side, but most of them are still negative. And that's notable. These type of companies, tech companies, still have not done amazing. They're behind the rest of the market. When I look at a different group of companies, let's take a look at my dividend portfolio. These are a lot more conservative, less flashy companies. These are ones that I think are great. This makes up my passive income portfolio. But you'll notice a difference there. Only around half the companies are in negative territory. I have around half that are in positive territory. So there is a discrepancy. Tech companies, for the most part, at least the ones I've selected, are still struggling. Apple's the only one that's positive. And then we have the passive income portfolio, the dividend companies, where around half of them have moved back up into positive momentum territory. So all that tells us is, generally speaking, how these companies are trading, and the majority of them are still technically on a dip. Now, right now, the story fund is down $26,000. So I'm $26,000 in the red. About a month ago, I was in the red by $40,000. A week ago, I was in the red by $20,000. So we're making some progress over time, but we're still heavily in the red. And don't get me wrong, I hate seeing this money in the red. I eventually want to get it back in the green and start making money. It's just been so difficult this year. There's no way around it unless you did some spectacular hedging, complex trading strategy or something. Most people that started investing in 2021 are going to be in the red this year, especially if you pick tech companies. So I'm in the red by 26,000, 31% money weighted. If I look at the simple returns, my companies are down 17%. So it's not quite as bad as it looks there. If I look at this against the S&P 500, this was updated as of just an hour ago. The blue line is the story fund. The red line is the S&P 500. So we're getting beat by the S&P 500. Not something I like to see. The two companies that have contributed to my biggest losses so far are Alibaba and Netflix. So those have hurt the returns, but overall we are making some ground. We're closing the gap a little bit, and we do a lot better when the market has any bullish sentiment at all. As long as we're still in bearish mode, as long as people are still talking about inflation and the Fed, and if the economy is going into recession, I don't do well. This portfolio doesn't do well as a bearish sentiment portfolio. The portfolio does do really well, and it really cruises upwards when there's any positive sentiment, bullish sentiment at all. So this is a game of patience. Most of the time, the market does go up. And so I think in most cases, I will make money with this portfolio. But over the past year, the market has gone down. Now, I want to go over my top holding here and some of the news related to it, which is Amazon. Amazon makes up a significant portion of my portfolio. It's the biggest holding by far. I have 41% of the portfolio into Amazon. And the next closest is Google with only 14%. And a lot of people have said, Joseph, it is irresponsible to have such a high concentration into one company. I think in most cases, that's correct. In most cases, putting so much capital into any single company brings on very specific risk. But I feel okay taking on that specific risk with a company like Amazon. And I think there's a handful of companies where it's okay to take on some specific risk and have a level of concentration if the company's an incredibly good company. An example of this is Warren Buffett. Warren Buffett does not like taking on a lot of risk. He doesn't like gambling. In fact, he does the opposite, where his first rule and his second rule is don't lose money and don't break rule one. He does not like to lose money. And regardless of that, he has a 40% portfolio weighting into Apple. He has an incredible amount of capital into one single company because Warren Buffett realizes the economics of the company. He realized it years ago. He's continued to add to the position, even as recent as last quarter, because again, he realizes how good of a company Apple is. Amazon is another company that I think investors do not realize how good of a company this is. What I see most investors doing is they look at Amazon, they look at the high PE ratio and go, it trades at a high PE, an 80 PE, it's super expensive. And then they look at the free cash flow and they go that it's not generating free cash flow. That's the big thing. Investors look at the price of the company, they look at the free cash flow, they say, I don't want to invest in it because of those reasons. I think that's the level of research most investors do on Amazon, and I think that misrepresents Amazon's economics, their earnings power, what they're doing in terms of their moat and their growth, and their future free cash flow earnings power. So having said that, let's go ahead and jump into some news regarding Amazon. We just got news that Peloton is now selling on Amazon, and this is breaking news because before this, Peloton was one of these premium brands that would not sell their products on Amazon because Amazon's just a big bulk retailer, sell anything on their website, right? So Peloton is saying, we don't want to be included with all these other sellers on Amazon.com. But now they've capitulated. They've conceded and they've said, we need to sell our product. Amazon is where we have to sell it. And there's a lot of funny and interesting things with this news report. So let's go ahead and listen in here.
Reporting that beginning today, Amazon shoppers going to be able to find Peloton products on the site. This includes Peloton's original bike and its strength product known as Guide. Comes a week after Peloton said it will aggressively be closing its brick and mortar stores. Lauren Thomas joins us right now with the news. She's a retail reporter, of course, at CNBC.com, and talked to Peloton's chief commercial officer earlier. Lauren, what's going on here, and how much does this change the game or not?
Yeah, good morning, Andrew. Like you said, if you're in the market for a Peloton bike, starting today, you're going to be able to buy that bike on Amazon should you choose. Now, this is really part of new CEO Barry McCarthy's plan to push the company toward profitability. Peloton also obviously has a goal to continue growing its base of customers. And
this is the first thing. So the news that Peloton is going to sell on Amazon bumped up the stock 17%. So investors are looking at that saying, Okay, this is a good thing for Peloton. They're selling on Amazon. That's a positive thing. It would have been concerning if Peloton stock dropped after they said they're going to sell on Amazon. The next thing that she mentions is the new CEO came in, and what did he do? He said, we have to focus on profitability. So when Peloton wasn't focused on profits, they weren't selling on Amazon. Now that they're focused on profitability, now they're selling on Amazon. See how that works? When they actually want to make money, they have to sell on Amazon.
And we've really seen demand start to slow as, pandemic restrictions have begun to loosen. So the company, as you said, is going to sell a selection of products. And I was able to talk to Kevin Corneals, Chief Commercial Officer at Peloton, about this news. Corneals told me already every month there are about 500,000 searches on Amazon for Peloton-related products.
Now, that's another thing. Peloton may have called up Amazon and said, hey, we're considering selling our products on your website. How much demand do you think there is? Do you have any analytics you can look at? And Amazon may have said, look, you're getting 500,000 searches a month on Amazon. So there's demand here if you want to sell it. That is how much demand is on Amazon for Peloton products without anything being listed on Amazon. So people are going and searching Amazon first because that's the preferred way to buy things. And then when they figure out that they can't buy it on Amazon, then they're going to Peloton.com. And you may lose customers in that process. If I search something on Amazon and I don't find it there, a lot of times I'll just forget about it because I don't want to go to some third-party website, enter in different payment information, worry about a whole different system to fulfill something. I'd rather just wait for a different product to be on Amazon. So 500,000 searches for Peloton products on Amazon is pretty significant considering they don't even sell on there right now.
So the company believes that the customer is there. He also said this is really going to be a test and learn approach. Peloton wants to test the waters with Amazon, but there's certainly a possibility that the company will strike other deals with other retailers down the road in order to gain further distribution. They
say Peloton may do other deals with other retailers to gain distribution. They don't have to. Amazon is the final stop. If you can buy a Peloton on Amazon, have it shipped to you in like 3 days, there's no need for anywhere else. That's what Peloton's going to find out. Oh, Amazon is the one-stop shop for distribution. They have it figured out. We don't need to go anywhere else. So they may put their products in other places, but once Peloton starts selling on Amazon, they're going to find that the majority of their sales come from Amazon.
So if you're a customer, you're checking out, you'll be able to have to pay to have delivery at home, where someone will come and install that bike. But you'll also be able to choose a self-assembly option. That's something Peloton hasn't offered before, and it's another lever that the company is testing to try to cut costs.
So that's interesting. It seems like they're going to have an optional checkout, like a customized checkout for Peloton, where you can select whether or not you want to have it be set up when it arrives at your house, or whether or not you want to have it be self-setup, which I think is something specific. So Amazon may throw in some customizable options for certain sellers. It seems like they're doing that for Peloton.
2 questions. One very practical for users and consumers. The other on the business side for investors in the company. On the user side or the consumer side, if you're a Prime member, do you get delivery for free? Do we know?
It's a great question. It's my understanding that should still be the case. There wouldn't be an extra fee.
So if you're a Prime member on Amazon, you get the Peloton delivery included for free.
There were reports actually at one time that Amazon was in very early stages of exploring a deal to buy Peloton. Obviously that has not come to fruition, but certainly this is a first step that the two are taking in order to work together.
The theory that Amazon was going to buy Peloton, I thought was actually a viable theory. When I looked at the options, a lot of people speculated that Apple was going to buy Peloton, and I literally never thought that was going to happen. I still don't think that will ever happen. I don't think Apple will ever buy Peloton. I don't think it fits with their brand image, the problems they've had with advertising. I think that if Apple is going to build a Peloton-like machine, they could just build it themselves. They have iPads and displays. They have things they can attach to bikes to make it work. So I don't think Apple ever wanted to buy Peloton. It never made sense, in my opinion. But Amazon is a company that I could see buying Peloton. I could see it happening. I think that it's unlikely, but they could end up buying it if the price got low enough, if Amazon could scoop it up for cheap and add it as part of their overall value proposition and make the Peloton membership part of the Amazon Prime membership, maybe a little additional add-on or something. So I could see that happening down the road, but I think that it's unlikely with the price that Peloton currently is. Most of the acquisitions Amazon has been doing are for cheaper companies.
In terms of margin, obviously direct to consumer, they capture basically the full price.
Right.
How much do they give away to Amazon in this case?
Right. I don't know an exact percentage on that, but what I will say is you've seen this trend play out with a lot of direct-to-consumer companies, right? Allbirds is a great example. Years ago, the company would tell me, we're never going to break into wholesale, or that certainly wasn't something that was top of mind, right? As this company launched online and then Allbirds had their own stores, similar to Peloton. Allbirds is now selling in Nordstrom. Allbirds is now striking partnerships with other retailers, just as now we're starting to see Peloton make that approach. I think a lot of these companies, they reach a point where they kind of max out with what they're capable of doing online and on their own. So it's inevitable ultimately that, retail comes full circle, right? These D2C brands, Peloton was included in that group, are now striking deals with companies that they see as key partners to their future growth.
Once they get to saturation in their own little circle, their own little Shopify website, they want to start selling for real, and they do that on websites like Amazon. Amazon is the platform for online sales. It's like being an app developer and not having your app on iPhone. That's basically what you're doing if you're not selling retail on Amazon. And this is a trend that I see happening more and more. Amazon is going to continue to court big brands like Peloton and others onto their website. The big problem that happened a few years ago was when Nike decided to stop selling directly on Amazon. That was a big blow to Amazon. A lot of investors looked at this and said, wow, they can make it on their own. How many other companies can make it on their own outside of Amazon? Let me just say this. Not every company is a Nike. In fact, basically no other company has the brand value of Nike. It is an incredibly unique company to build out their own direct-to-consumer relationship with their app and website as strong as Nike has. Not many companies are going to be able to pull this off. Nike's incredibly rare in being able to avoid and circumvent Amazon. It's just not something most of them can do. So overall, outside of a couple companies like Nike, I see the huge majority making their store presence on Amazon because it's basically unavoidable. If you want to sell mass quantities, you have to sell through Amazon. Now, we also have some other Amazon news here. From Seeking Alpha, they say Amazon continues to grab e-commerce market share per Bank of America data. I don't know why they have a snowflake picture here. This article and write-up has nothing to do with Snowflake, so maybe just a wrong image there. Now, this Bank of America analyst said that Amazon's e-commerce growth rates have picked up in Q3. And he's saying that it's just specifically Amazon, not just overall e-commerce growth. The firm estimated that in the US, Amazon's growth accelerated to 17% in Q3 from 5% in Q2 to outpace the gains seen by online Target and Walmart.com. So not just Target and Walmart retail, but their online efforts, as well as the overall online retail industry average. So according to this analysis, Amazon is actually growing their online retail quicker than the overall market, which means that they're actually gaining market share in online retail. And they're basing these estimates on credit card and debit card data. I don't know how accurate that is, but it seems like credit card and debit card data would be more accurate than website visits. A lot of people do analysis based on how much Amazon.com is ranking in the search trends and website visits. But credit card data, I think, seems more accurate. They say the Prime Day event during the quarter was the biggest factor in the impressive growth estimate, although improved product selection and delivery times for Amazon were also a growth tailwind. And they say looking forward, the team expects a couple points of market share gain through 2024 for Amazon as it continues to benefit from the massive fulfillment investment in 2020 and 2022. They maintain a buy on Amazon with a price target of $170. So this Bank of America analyst really thinks that they're taking market share from competitors and that the growth rate will go back up to 17% from the 7% it was last quarter. Now, that seems a little aggressive in my opinion. I don't know if they'll be able to do that, but I do think that the growth rate will reaccelerate. Now, my game plan for Amazon, I'm in the red by 5,000 right now. That's around 11% down on it. What I plan on doing is anytime this company dips down close to $100 per share, I'll just be adding a little bit to it. If it doesn't dip down, if it just goes back up, then I'm just going to hold it. So that's how I'm playing this company. Anytime it goes down close to $100, 120, 115, I'll buy a little bit more of the company. But as of right now, when it's floating around the 130 to 140 range, I'm just holding on to it because I already have a significant position. Now, moving on from that, we have the breaking story. This is the big story of the Twitter whistleblower, an ex-employee. He blew the whistle and he complicated things for Twitter to the benefit of Elon Musk. Now, before we get into this story, I have to do a quick shout out for the sponsor of this video, FTX US. You know them. They are the large cryptocurrency exchange. I don't really do anything with crypto. Everyone knows that. So I've been waiting for them to come out with their stock platform, and they finally released it out of beta. Anyone in the US can sign up for it right now using one of the links in the pinned comment below. This is what it looks like. It's a very simple interface, very easy to use. You have the market value, profit and loss of the portfolio, the return percentage there. I only have these two holdings, Amazon and Adobe, but it works very easily. You can buy and sell anytime the market's open using fractional shares. And FTX does not do payment for order flows. So if you use one of the links in the pinned comment to sign up, just make sure to use the referral code Carlson. That'll get you $10 credited to your account upon your first $100 trade. So go ahead and try it out and let me know what you think. Now, in this whistleblower complaint, the former head of security said he, quote, uncovered extreme, egregious deficiencies by Twitter in every area of his mandate. This included privacy, digital and physical security, platform integrity, and content moderation. So what he did was not really go after anything specifically. He just bashed Twitter in every possible way. Everything related somewhat to his job with security, moderation, the bots, everything. He went after Twitter in every way possible. Now, this is not a good thing for Twitter, obviously. It looks really bad. It complicates the trial. I thought before this that Elon had a much weaker case. I really did, because I read through both of their complaints, and I just thought Twitter's was way more sound. Now this is throwing a kink into it. It's complicated things, but I'm very skeptical about this person's motivation. A Twitter spokesperson said that Mr. Zatko was fired for ineffective leadership and poor performance, and that the complaint is, quote, riddled with inconsistencies and inaccuracies and lacks important context. I tend to believe Twitter here. What this strikes me as immediately when seeing this complaint and the timing of it is an employee that has the motivation to hurt Twitter. And this is a formerly employed employee that was fired from the company, otherwise called a disgruntled employee. When you fire someone, that's not a fun thing to go through, right? And a lot of them might be upset about the management, about the company. They might say, those guys are bad. They didn't want me there. They're a bunch of dummies. And then some employees might look for ways to exact revenge on the company. That's why when companies let go of people, they close off their emails. They close off their accounts, their management accounts. They shut everything down immediately. That's part of the offboarding process, is to get everything shut down so that the employee can't do anything to exact revenge on the company, to act in an emotional, disgruntled way to potentially damage the company. Now, some employees in higher ranking positions have different tools to be able to do things to hurt the company they used to work for. In this case, this is the head of security. He had a history of speaking truth to power and doing these type of things in the past. And now he's doing it with Twitter, saying that they're doing everything wrong and all of their security is wrong. And look at this data breach. Now, this is one thing that he actually brought up in the complaint that I think that he wasn't really thinking about, because I think this actually helps out Twitter. He says, quote, there are many millions of active accounts that are not considered MDAUs. MDAUs are monetizable daily active users, the monetizable ones, either because they are spam bots or because Twitter does not believe it can monetize them. Mr. Zatko said in the complaint, quote, these millions of non-MDAUs account are part of the median user experiences on the platform. So what he's saying here in this paragraph is there's a million users, millions of users that are not counted as the MDAUs because Twitter did not believe that they can monetize them. That's a good thing for Twitter. This shows that Twitter was not trying to bump up the numbers of their monetizable daily active users by including bots and spam accounts in that number. This, I think, actually speaks to the benefit of Twitter, not to their detriment. Now, the CEO of Twitter responded to this in an internal memo to employees saying, quote, I know this is frustrating and confusing to read, given Mudge, that was the nickname of this whistleblower employee. Mudge was accountable for many aspects of the work that he is now inaccurately portraying more than 6 months after his termination. And he goes on to say, we will pursue all paths to defend the integrity as a company and set the record straight. So That's the response. They go back and forth there. In reality, can we make any definitive conclusions on this? Not really. We don't have the information. We can't even read the full report. So everything we say right now about this story is basically just speculation. Now, having said that, part of this does strike me potentially, I don't know for sure, but potentially as a former employee that is disgruntled because he was terminated from the company and he was looking for a way to potentially get back at Twitter. And this opportunity presented itself. And this is a very good opportunity. If he wanted to get back at Twitter, this was an effective way to do it. So I do think that that motive probably played a role. Having said that, I don't really think that everything he brought up is necessarily untrue. There's probably a lot of truth to the mismanagement and all the problems that Twitter's facing. So I think there's some nuance to this. So everything right now is basically speculation. We have to see how this turns out. And I'll continue to follow this case and how it turns out. If the judge decides along the lines of Twitter or Elon Musk, either way, we're going to find out in the coming weeks. That's all for this episode. I hope you enjoyed, and I'll see you in the next one.